As an independent registered investment advisor over the past 10 years, I have focused my entire practice on shining light on what I've described as extremely unfair service charges, conflicts of interest, and a complete lack of transparency in the 401k plan industry. Over this time, I have learned a great deal of extremely valuable information, and I wanted to share this information with as many people as possible because I thought it would really make a difference. Before I get into all the details that I think are important for everyone to know, I want to explain just how I came to learn everything that I know. And it really all started with a conversation I had with a colleague of mine. This was about 15 years ago. And this colleague told me how you could look up any 401k plan tax form online. And I was really interested. And I started looking into it a little bit, but I wasn't really sure what to do with the information. But a few years later, I started looking into everything in a little bit more detail, and I took it further this time by making phone calls to business owners explaining what I saw, especially those business owners who had the most significant charges that I'd seen. The responses, however, really surprised me. The main responses were either they didn't know there were any fees at all, or they knew there were some fees associated because everybody had to make money, but they really didn't believe they were actually paying for them. And you know what? I don't blame them, because if you've never seen a fee ever, and all of a sudden you get a call from a complete stranger saying that there's tens of thousands of dollars in charges that have been incurred at the participant level, which is namely passed on to the business owner who often has one of the, if not the largest balances, it's easy to be a little bit skeptical. So based on these responses, I realized something had to change if anyone actually wanted to make a difference. And I realized also that I could become a consultant just for this one industry alone and maybe even change the way in which the industry does business. Okay, I have not actually changed the whole industry just yet. However, I have made a little bit of a difference, and I have a significant practice at this point. And I hope to continue to share information with people through this medium, because this is a way to reach a lot more people, and I hope people really listen. So I'll start by explaining who all the players are, which are primarily record keepers, administrators, custodians, financial advisors, and mutual fund companies. And I'll go through each one and how they operate. And I'll start with record keepers. Record keepers, just like the name sounds, keep records. Some of these records include keeping track of loans, as well as keeping track of changes in participant account balances. It also includes customer support numbers for both the employers and the employees, and it includes a website with all these quote-unquote valuable tools that employees don't necessarily use, at least not enough to justify paying for them, and I'll explain that a little bit later on. You also have administrators who are responsible for helping the employer effectively design the plan, because there's many different ways in which to design a plan that may or may not be in accordance with the business owner's needs. They also handle the compliance functions, because there's quite a bit of government regulations to make sure that you comply with. That also includes preparing the tax form. The record keeper does a little bit of the compliance function as well. Then you have the custodian. Custodian example would be Charles Schwab or TD Ameritrade, Fidelity, MG Trust Company, and they simply charge a small fee for holding the money. You also have mutual fund companies, which can be either focused on active management or passive management. The main difference is that if a mutual fund is actively managed, that means that the manager actively trades the securities within the mutual fund in the hopes of outperforming the benchmark or the market. And it can be a little bit confusing just what that benchmark is. In fact, if you ever heard the term moving the goalpost, kind of like moving the benchmarks, those performances of those mutual funds might look worse or better depending on how the numbers are framed. Passive management refers to a mutual fund manager. So if it's a passively managed fund, it's a mutual fund manager who's still trading the securities within the fund, but not nearly as often, because their goal is simply to keep the fund in line with a particular benchmark. And because that requires a lot less work, Therefore, there's a significantly lower fee. It's very difficult to consistently outperform the benchmark, and I'll get into why the advisors so often recommend actively managed funds in a minute. The analogy I give is playing blackjack. Now, I know how to count cards at blackjack, and even though I know how to do that, it doesn't mean I always win, because it takes a tremendous amount of time, energy, and skill to actually consistently win money playing blackjack. You have to eyeball the thickness of the deck and divide by the number of decks remaining to arrive at what's known as the adjusted true count. You probably want to have a more advanced card counting strategy. You have to know exactly which game to play, because each game has different rules. When I say game, there's different tables. Some are 2 decks, some are 6 decks. There's different places that have different rules, and each individual rule will affect your probability of success either positively or negatively. Now, if that sounds complicated, try to attempt to consistently outperform the market on a consistent basis over a long period of time and beat the very best institutional fund managers and institutional investors, or even average investors in the world. That's a very difficult thing to do. So this is exactly why I often recommend passive management. Now, let's go into how financial advisors get paid and who are the different types of financial advisors. The first, and this is the more common type of advisor in plans that are smaller, which are known as brokers. A broker cannot legally provide advice. A broker can only legally provide education, because a broker cannot get a direct fee. They can only get what's known as a commission, what's also known as revenue sharing, or what some people don't like to say is a kickback that's built into some funds and not other funds. And sometimes these kickbacks are different depending on which fund is invested in. And of course, these are also based on a percentage of the overall account value. A registered investment advisor is known as a fiduciary who can legally provide advice. They don't receive any third-party compensation because they charge a direct fee. However, that direct fee is often still what's known as a management fee. These management fees are especially problematic because they do not reflect the actual amount of work that advisors do. Managing a $1 million account does not require any more work or any less work than managing a $3 million account. It's no different if it's a $5 million or a $10 million account. Yet as contributions are put into the account, it pushes up the account value, as well as unnecessarily pushes up the advisor's fees and the record keeper's fees, who often charge unfairly based on a percentage of the account value, even though these parties do not provide any additional services whatsoever in return for these additional fees. Management, though, is an interesting term, because what that consists of is simply selecting and monitoring a fund lineup, which has become a commoditized process. Technology has advanced over the years. We all know this. And through technology, financial technology, it's very easy to select and monitor a fund lineup. In fact, many of these fund lineups, and this is according not just to me, but to Ted Benna, the guy who actually created the 401k plan as a result of discovering a loophole in the tax code in the early 1980s that he shared with his clients. Many 401k plans actually just have a fund lineup that looks the same. This is not an original piece of work. And yet, advisors are marketing themselves not only as managers, even though they don't do any managing, but they're marketing themselves as service providers, professionals who are doing an original piece of work when there clearly is no original piece of work being done. Even independent fiduciaries are marketing themselves this way. And this is precisely why, and Ted Benna echoes these sentiments as well, advisors need to get back to a fee-for-service model, just like other service providers such as engineers, accountants, or attorneys. They need to charge in a way that's commensurate with the level of services that they are providing. And once they do that, it might become more clear that the business owner is much better off simply writing them a check. From a compliance standpoint, it's much easier, simpler, and cleaner because there's no requirement to benchmark fees that are not passed on to the participants. That requirement, or really suggestion, I believe, is made by the Department of Labor, is based on ensuring that participant-level fees are reasonable. Furthermore, in many cases, the business owner has the largest balance, and that means they are paying the largest share of participant level fees. But if they're writing a check, they can actually deduct that as a business expense, and it winds up being a much better deal for everybody. It could be a great recruiting tool if you're a business owner and you're literally paying all the fees to the employees. And if you're an employee and you've watched this video and you know the impact of fees, then you will have a much, much better plan, and you will have a great tool to motivate, attract, and retain key employees. But let's quantify the impact of fees a little more. Let's say you have $50,000 in your account and you're paying simply an additional 1% in fees. 1% doesn't sound like much, but it is quite a bit. That comes out to $500. And if you think of money in terms of dollars, which most people do, I certainly do, you'll understand that $500 every year is a lot. If you think of money in terms of monthly cost, you divide that by 12 and you get $41.67 per month. When I negotiate my Comcast bill and I save $20 a month as a result of my negotiation, I'm pretty happy. I know I just saved $20 a month. When we see any other bill being reduced by a monthly amount, we think of stuff in terms of monthly fees in many cases. This is actually a really big deal, but we don't think of our 401k plan fees in terms of monthly fees, but we should. The Department of Labor quantifies the impact of fees as well by citing a 35-year-old, or I should say someone with 35 years to retirement, this was the exact example, who has a $25,000 balance. And over time, simply paying an additional 1% in fees will result in a reduction of the account value by $64,000, or in a percentage term, that comes out to 28%. And when you take your money out and you pay taxes, you're going to pay your applicable tax rate, which is going to be between federal and state, at least 20% or more. So what that means is that more than half of your balance is going to be gone due to the effect of both fees and taxes. Something like that should never happen. And this is exactly why I created a website that's intended to provide nothing more than a public service, just information, doesn't sell anything, that details much of what I've already said, as well as a list of much more economical, flat fee-based providers that often do not get entered into the benchmarking search. And when I say benchmarking search, many businesses will, quote unquote, benchmark their plan against other plans to make sure that their fees are reasonable. But what they do is they benchmark their plans against the other unnecessarily expensive asset-based fee providers. And then they seem healthy, but when you compare your health to a bunch of other sick people, and according to the benchmarking, you're healthy, it is extremely misleading. This is exactly why financial advisors often recommend these unnecessarily expensive asset-based fee providers, because if they recommended a less expensive provider that charges on a flat fee, it would call their outdated and, I believe, unethical service model into question. And then the business owner would ask, why don't I write you a check? If business owners were sent a bill for the amounts that advisors and record keepers continue to extract out of the accounts, their fees would go down drastically and immediately. However, the administrators often do charge a very small, flat quarterly fee. Yet these administrators get paid far less than the advisors. That should raise a red flag that when you spend your own money on yourself, and this is exactly the chart, the 4 ways to spend money, which is on my blog, retirementracket.com, that Milton Friedman depicts. It's much better to spend your own money on yourself than it is to spend other people's money on someone else.